right, accounting students, we're getting near the end. Today we're going to look at a multi-step income statement. So early in the year we looked at an income statement. I don't know if you remember way back in Module 1 in the first couple weeks of school. I gave you a bunch of accounts with some numbers, and I said, tell me what the income for this business was. So remember, I gave you like sales 20,000, cash 8,000, accounts receivable 4,000, inventory 3, and I gave you all these numbers, and you had to classify whether the account is a revenue or an expense, and then you did the calculation. And you ignored all the balance sheet accounts, and if I were to pull those problems out again, and you'd probably kind of laugh and be like, wait a second, I couldn't do that. Well, now not only we got to Module 3 and you're able to make an income statement from adjusted trial balance, now what we're going to do is we're going to create what is called a multi-step income statement. So what it does is it focuses in on operating income before from continuing operations, and then it's going to have other things that kind of occur throughout the year, like discontinued operations and things like that. And we're going to work our way down to net income. All right, so let's kind of break this down real quick. So it always starts with sales, your cost of goods sold, and then your margin. Okay, so or gross profit, whatever you want to call it. And so here, remember the gross margin ratio is a relationship between margin and sales and that percentage. And remember, the focus of businesses is always to increase that margin. So they could do that in a couple different ways. A, they could raise the selling price and sell more of something. Or B, they could just get better with their cost of goods sold. Find a less expensive way to make their product. Find a better supplier. Find better, types of overhead cost decrease, like we talked about in Module 4. So you can kind of see where this is all piecing together. We're telling the story here. So this business sold $16,000 worth of stuff. They had a COGS number at 9,600, and their margin is at 6,400. So then we take out our selling and admin expenses. So this business has 5,800 in selling and admin expenses, and we work our way down then to operating income. So now the next part becomes the other. I call it the other things that occur that's outside of operations. So here we have dividend revenue, interest revenue, Module 6 stuff with gain and loss on sale of equipment. Remember, we did that for a while. We calculated whether or not we had a gain or loss. And I told you that if it's a gain, it's going to act as a credit, and if it's a loss, it's going to act as a debit. And the reason why we kept saying that is because now it's going to appear on the income statement. And so when we have a gain on the sale of equipment, that's going to cause our income to go up. And when we have a loss, it's going to make our income go down. So in this business, if you look at 60, that means that they have a gain there. They have a gain on the sale of equipment of 60. Interest expense gets plugged in here at 422. And then we have income from continuing operations before taxes. So this is your kind of what we talked about early in the year. We talked about that as being EBT, earnings before taxes. Here's our EBIT number. We don't really see that on here anymore, but here's that interest expense, and that's going to lower the amount that we have to set aside for taxes. All right, so then we have our continuing operations before taxes. And that's the difference between the operating income and all the others here. And then we have our provision for taxes at 76. We work our way down to income from continuing operations at 288. Now, some businesses have what's called discontinued operations. A good example, let me think. A lot of women in my family loved Saturn cars. I thought Saturn had a really good thing going. I grew up in Tinley Park, southwest suburbs. We didn't have as many luxury cars floating around. Incomes weren't as high as they are in the North Shore. And so a good quality car that was made were called Saturns. And what was nice about Saturns is they had a different business model. Their business model, you did not negotiate the price. They had the stated price when you walked into the dealer and you saw the price. You could not negotiate off of it, and that was the price that you paid for the car. So obviously a lot of people don't like going into car dealerships and haggling over price. And at the same time, the cars were very well made, very well designed, and they were good little cars that lasted a long time. Even my wife, when we got married, she had an old Saturn. It was a stick shift, and the thing had a gajillion miles on it, and it was just kept going and going and going. And so eventually, though, they could not make new cars that got their target market excited, and their sales kind of slugged, went down a little bit. Preferences changed, and so eventually GM was the parent company of Saturn. They discontinued Saturns. All right, so when they discontinue a car line, there's going to be gains or losses on the discontinue the operations, salvaging the assets. Sometimes when you discontinue, you might sell off the product or service, whatever that you're looking to sell off and discontinue. And businesses will do that because it might not fit in their strategy anymore, and or they just kind of want to focus and go in a different direction. And so when we think of like a company like Microsoft, holy smokes, in the 90s, they sold so many operating systems and software, and that was kind of their big focus. And now you look at a lot of stuff they're doing is now they're doing cloud computing and different things like that. So companies, good companies, well-run companies are going to change and adapt to opportunity. We're seeing that right now in the marketplace with a lot of businesses. So whether time's good, bad, the opportunities are always going to be shifting. So well-run companies are going to seize those opportunities and kind of go with that. So if you look at a company like Disney right now, all their theme parks, yeah, they're all shut down. But remember, that's only one of 4 revenue segments that Disney has. They also have television, they have movies, and then they have merchandise. So if you look at their television, it was kind of a dying duck a couple years back. People were cutting the cord on cable. And remember, they own ESPN. I think they were getting something like, I think it was like $5 or $6 for every cable subscription was going to Disney off of the ESPN/Disney franchise. And so when hundreds of thousands of people started cutting the cord, they were getting kind of destroyed there on the TV side. But luckily, their movies, when you look at the top 10 grossing movies year in and year out, you're going to see Disney's name appear so many times, not only once, not only twice, but more than a handful of times in that top 10 are Disney movies. Go back and look at the research. So Disney is just such a well-run company, but they do discontinue operations. I'm not saying right here they're shutting down their theme parks. The theme parks will be back and running at some point, but businesses do have to make that thing. So getting back to GM, GM discontinued Pontiac. I'm trying to think Oldsmobile. My first car was a 1988 Oldsmobile Delta 88. That thing was amazing and had 180,000 miles on it. It ran like a tank. For some reason, I got 32 miles a gallon. I can never figure out why. That was another GM brand that got discontinued. So Hummer was another one. Our late Jerry Trossman, one of my favorite subs of all time, she drove around in a huge red Hummer, and the Hummer was part of GM, and that got discontinued. So we have, companies make those decisions. All right, and more recently, if we look at Ford, Ford is discontinuing all their cars except for the Ford Mustang. So they're going to move in that direction because they're not profitable enough for the business model. So they're going to focus more on trucks and then stick with the Mustang. All right, so that would be gain or loss, and that's what a discontinued operation is. It's outside the normal operation cycle of what goes on in a business. So when it does get discontinued, it's going to get dumped below that, and then you work your way down to net income. So there's the net income of 388. And so then you have the formula earnings per share. Okay, so discontinued, I already kind of went over that. Earnings per share, so measures the earnings of a company. It levels the playing field by reporting on a per share basis so we can compare companies no matter the size of the company. So your EPS number is your net income, which I just showed you, and you're going to take out any preferred stock dividends. Preferred stock dividends we've already talked about in the class. Not all companies have preferred stock, but you take the preferred stock dividend out because earnings per share is what is afforded to the owners of the company, which happen to be the outstanding shares of common stock. So we're going to take the net income, take out our preferred dividend, and we divide that by the weighted average. Because remember, companies, and if we see this right now with stock buybacks over the last few years, companies have huge swings in their outstanding shares because they're buying back large droves of stock. Once they buy back that stock, we already talked about this, that goes into treasury stock. Treasury stock decreases equity, And the outstanding shares, the definition of outstanding shares, are shares that are held by the company. So they're decreasing the outstanding share amount. And so one way that businesses focus on increasing earnings per share is they could grow income. So they could grow income by selling products at a higher selling price. 2, they could they could cut costs and find ways to get their margins down. By cutting cost of goods sold. They could be more efficient with SG&A. They could pay down their debts. They're not carrying large interest expense loads, so that would increase income. So there's a lot of different. We could turn this easily into a finance class, but we're not going to do that right now at this point. But what I want you to understand is the reason why you do a weighted average is because those outstanding shares could potentially fluctuate throughout the year as companies buy back their own stock and or if they issue new stock. So you do kind of like an average. All right. So that's your earnings per share number. And so do not forget to include this number at the end of the income statement. So the earnings per share number, when you pull up an income statement, at the bottom of the income statement, it will have the EPS number. Just to kind of escape out here for a second, I'm just going to go into, we'll just go into Yahoo Finance. This is a nice free. You get information on companies real quickly. So if you just go in there, type in the symbol of company. We'll type in Apple. AAPL is the company we kind of been looking at all year. So when you pull up in Yahoo Finance, it has the in there. If you start looking, one of the major things they're going to have is the earnings per share number. Oops, I'm not in Apple. I'm in some different company. Hold on. Sorry about that. I clicked on the wrong thing there. Let's try one more time. Okay, there we go. That was a close one. All right, so Apple is $3.15 a share. I tell my sons, I said it's harder than it looks when you're talking at a computer and you're trying to control at the same time. Take some practice. All right, so if we look at Apple's earning per share number is $12.73. So for every outstanding share that's held by the company, Apple earns $12.73 per share. And when you look at that, that's pretty good. And another metric that we were not really going to kind of get into, but I just want you to understand, if you take the price of the stock and you divide it by the earnings per share amount, that gives you what's called the P ratio. So the price to earnings ratio is a way you could quickly compare companies in the same industry to see, where the stock is the stock overvalued? And maybe the stock is overvalued because there's big expectations. So right now, one company that's getting a lot of press nowadays is Tesla. So if we look at Tesla, this one is up to $811 a share. All right. And if we look at the P ratio, it's NA. And if we look at earnings per share, it's negative 81 cents a share. So what this means, for every share of Tesla that's held, the company loses 81 cents per every share that's held. And so in here, when you really kind of think about that, you're kind of like, well, how does that happen? Because stock is a forward-looking mechanism on what the future prospects of a company is going to do. We could go back to Amazon, and I can't remember the year they became profitable, but it wasn't too long ago. But of course, to you guys, 4 years could seem like a lifetime. But when we look at the chart here, you could kind of see going back to 97, this thing was trading, $50, $60 is jumping around here. It wasn't very high. It had its points. Look at that, down to $14 in 02. There was a dot-com bust. And then all of a sudden, you just have this price appreciation. And remember, in most of this run up here, they were losing money, but it was a future expectation that they were eventually going to turn profitable. And sure enough, today, if we look for every share that's held, we have earnings per share of $20.94. But here's the thing: the P ratio, which a normal P ratio of a company is in the low 20s for the overall market. We still have a high P ratio for Amazon. So there's huge expectations that this company is going to keep on profiting and growing and doing well. All right, so that takes us kind of back to our PowerPoint. And so if we look in here, let me just kind of scroll down. We'll get into comprehensive income another time. That's a big discussion. But what I want you to do is just kind of take this 15-minute video and then work through the multi-step income statement calculation and just dump that in your notes. And I'll go over that tomorrow, and then we'll start talking about comprehensive income. All right. Thank you.